Fed has a plan, and this is actually the title of our article for tomorrow, for our macro view for the weekend, which is the Fed has a plan to create inflation. Same plan they had back in the last decade, but they're going to have a new plan to create inflation. We're going to talk about that some today, and actually whether or not they'll be kind of successful at that. But I have really good news for you this morning. The S&P 500 right now is only 2% from all-time highs. That's right. It's kind of hard to believe here. I mean, right? You've got an economy that just printed off basically a 38% recessionary tack on an inflation-adjusted basis. You've got 50 million people unemployed, but the S&P is now 2% from its all-time highs. And that's actually good news because our good friends over at Sentiment Trader ran an analysis on this, talking about what happens historically when the markets hit a new high 6 months after a bear market. So this is pretty incredible if you actually look at this. What is interesting if you actually look at these numbers up front, over the next 1 week to 2 months, once you get here, you typically have a correction in the markets. Now, they're not big, but you do get a pullback in the market to some degree, which is not surprising. I mean, you've had a big advance here, so seeing a little bit of sloppiness over the next month or two would be well in line with what you would expect with an August-September time period. And those can range anywhere from about 3% to 4%, somewhere in that range over the course of the next couple of months. So that's not surprising. The positive side of this is that when you do that, and obviously when markets set new highs, over the next year, the next 12 months, markets tend to be higher on almost every case. Roughly about 92% of the time, the markets are higher 12 months after markets get back to where they are right now. So, the idea here is you get an economic recovery, you start seeing earnings recover here over the course of the next few months, then that helps lift asset prices higher. But look, I mean, there's no doubt this has been a very, very big run from the lows. Lots of it's been liquidity fueled at this point. And here's one of the interesting side notes of this is that while the market's been rallying, we've talked about this on the show before, which is that it's really being driven by just a small handful of stocks, right? Basically your FAANG stocks: Facebook, Apple, Amazon, Netflix, Microsoft, Google. Those stocks, those core stocks now have more market cap. This is pretty incredible when you think about it. The market cap of just those FAANG stocks now make up more than the entire market cap of energy, financials, industrials, and materials combined. So, that's, a bit of distortion of capitalism, at least to say the least. But, obviously that can't continue to last. But the problem here is at some point when you do get a correction in those stocks, which you will, it's going to lead to a bigger correction in the overall market simply because of the function that they do make up such a big chunk of the market. Now, Apple, as we showed yesterday on the show, now makes up a very large chunk, about 6.5% of the S&P all by itself. So, I mean, that's going to be one of the problems. Eventually, Apple stumbles. Eventually, Amazon stumbles. It happens throughout history. Earnings will slow. The company is just too big. You'll have some antitrust regulatory issue come in, causes these stocks to stumble. That creates the problem with the overall market. So just pay attention to that. This is kind of a distortion in the markets. That's what's happening. But nonetheless, the overall positive bullish bias certainly remains intact. And that really shows up here, as we talked about in Tuesday's Commitment of Traders report. Volatility has now been suppressed back to very low levels. So as traders have gotten more bullish in the markets, they've been basically stripping volatility out of the market. Shorting volatility has been an excellent trade for bullish traders in the options market right now. Volatility is now back to lows. Now, that suggests two things. One, there's absolutely no fear of a correction at this point. And the other thing is that provides the fuel for a correction, obviously. When that happens, you get a nice big drop off in the markets because of when you compress volatility, when it reverses, it has basically an explosion in the markets. But that's what we were talking about Tuesday on our Commitment of Traders report, is that short positions on volatility have been rising very, very sharply here since the March lows. And we're back to levels that provide that basic fuel ultimately for correction when it ultimately occurs. Outside of that, though, is that, financial conditions, this is a problem for the Fed. We'll talk a little bit about this morning with Michael Leibowitz when he joins us, but financial conditions also back to pre-crisis levels. So, this makes it a bit more difficult for the Fed to do more monetary policy because there's not really a need for it. If you take a look at a lot of the programs, the PPP program, the Main Street Lending program, the corporate bond program, all these, there's not really a lot of uptake. These programs were very big when they were put into place, and there's only been a very small uptake in these programs. And with the financial conditions back to very low levels, companies being able to split stocks like Apple or share stocks in the sell stocks in the open market to raise capital, they have no problem going to the bond market to issue debt, either high yield or investment grade. No problems there. Basically, financial conditions, yield spreads, all very much back to very low levels, really suggest that the ability for the Fed to do a lot here at this point is going to become much more limited. So this is going to be one of the problems potentially that liquidity faces here over the next few months. And again, we'll be paying attention to it, but with financial conditions so already back to very low levels, not a lot of need for additional liquidity at this point. A couple of other just sidetracks here for a moment, just talking about the world around us. UI benefits is obviously the big conversation. Donald Trump yesterday talking about, well, he can take executive action on unemployment insurance benefits or the eviction moratorium here. And UI benefits without the additional $600, this is one of the big concerns for the markets and for the economy, is that without that extra $600, UI benefits barely cover the average expenses of the individual person. So this is why this is such an important thing, because our entire economic dependency right now has been based on that additional benefit. So that's one of the big reasons why they're trying to get this done and get this pushed out. We'll see what President Trump says about this. Also, too, it's time to send kids back to school. They took a poll this morning talking about, would you send your kids back to school? Most Americans, which is on the far right-hand side here, most Americans say, yeah, they'd send them back within 12 months. The problem is they didn't ask the right question. Would you send your kid back to school if you would stop day drinking? And that answer was probably a lot higher. And the other question is, would you send your kid back to school if you could have your computer back because he's making more on Robinhood than you are on UI benefits? So that was the other question they didn't ask. Lastly here, I thought this was really important here because we've got the election coming up, and they took a poll of people and they said, what's the most important thing for the election to cover? The answers were the economy, healthcare, coronavirus, national security, education, taxes, immigration, the environment, blah, blah, blah. You know what's not on that list anywhere? Budgets, debts, deficits, Social Security solvency, sound money, basically anything that matters to the economy long term and the health and wealth and prosperity of the average American, nowhere on the list. So, that's maybe we should start to focus on the issues that ultimately matter for the average American. But again, if you take a look at this, most people were obviously concerned about the economy, and at the bottom was relations with China. So maybe we need to start focusing on things that matter, ultimately, like our budget. Anyway, that wraps up our morning opening here. When we come back after the break, I'm going to get with Michael Leibowitz. We're going to talk a little bit about these sound money issues, right? Inflation, deflation, Fed policy, what all that means, and are they actually going to be able to create inflation, or is it just all a big deflationary spiral? Is that where we are? I'm your host, Lance Roberts, for Real Investment Advice. Don't go away. We'll be right back.
Got questions for Lance later? Ask now at realinvestmentadvice.com.